And good morning once again, options traders. Well, a comment that I hear from a lot of people out there is that they like to trade spreads because they're easier to trade. And when I ask them why, they say, well, the answer is very easy, because you have less money to lose, and therefore it's easier. Well, okay, that might be true that you have a smaller max loss, but you've also got two option positions, one long and one short. And you need to be aware of that before you start trading your spreads, or if you want to make the most of those trading decisions. So here's why. Let's take a quick look at spreads. Remember that the basic definition is that you're going to be selling one asset against another. And they're generally an offsetting transaction, which means that when one goes up, the other goes down. So they're usually on the same underlying asset, not always, but they should at least be highly correlated. So for example, let's assume that you buy 100 shares of stock and sell a 105 call, or a covered call. This is a type of spread. We have a long position and a short position. They're on the same underlying stock, and when one goes up, the other goes down. So they tend to play off of each other. That's one way of understanding a hedged position or a spread. What if you buy a $100 call and buy a $100 put? Well, in this case, you're actually buying two options, but one is long, has positive deltas, that's the long call, and one has negative deltas, that's the long put. So in a sense here, you could actually call this a spread. When the call goes up, the put goes down, and vice versa. But when most options traders hear the word spreads, they generally think of it as buying an option and selling another option against it. So let's say buying the $100 call and selling the 105 call. This would be a vertical spread. But regardless of which type of spread you're using, you have to understand that you have multiple positions. And if one option can have some complexities to it, and they definitely do, two options are going to be even more, and probably more than twice as much, because you've got a long position and a short position. And because of this, you actually need more knowledge to trade your spreads. It's not enough to just say that you're bullish or bearish. And yet that's what a lot of people do when they put on a vertical spread. They say, well, I'm bullish, let me go buy the call spread or sell the put spread. That's just the starting. And again, with the spread, you're profiting from the relationships between the two assets. You have to understand how this spread is going to profit from one asset going up and the other going down. And that's a lot different from just saying that you're bullish. You also have to understand the relationships between the strikes. And you must also understand relationships between expirations, because all of these are going on, and especially with your decisions. Which strikes should you use? How wide should they be? Which expirations? The decisions are not always so easy. So for instance, here's a risk graph for the 100-105 vertical spread. So here's our bend at the long strike at 100. Here's our other bend at the short 105. So let's say that the maximum loss is 3, and therefore because it's a $5 spread, that's the difference in the strikes, that's the most the spread could ever be worth. So if you spent 3, the maximum gain is 2. So remember that this curve right here is called the expiration curve. And it's called that for a reason. The only time you should be looking at this is right at expiration. So let's call it 3:59 p.m. Eastern Time on expiration day. That's when this curve applies. And that's why sometimes traders get confused and they say, well, the stock's at 105 with 2 months to go. How come I'm not at maximum gain? Because you're not at expiration yet. All of that extrinsic value has not bled out of the positions. So that's important to understand, that this curve, this expiration graph, only applies at a very small moment in time. Prior to expiration, let's say with maybe 30 days to go, this is what your risk graph might look like. So instead of looking at the black curve, which is the expiration graph, we look at the red curve. This is the current curve, and we read it in exactly the same way as we do for the black. If the stock is 105, we trace a line up to until we hit the current curve, we look left, and we would say this is the theoretical value of the spread right now. If the stock gets up to 110 today, we trace a line up until we hit the red line, we look left, and it looks like it might be worth about $1.50 today. If it's 110 at expiration, then we look at the black curve and see that it's worth 2. So as time passes, this red curve, at least in this region, will move up towards the black, towards the expiration graph, And over here in this region, we'll move down. This is going to be your portion of negative theta over here. So just remember that the red curve moves towards the black as time passes. So that's all fine and good, but what happens if volatility changes? Here's something that a lot of the new traders don't consider. Let's say that the stock is at 105 or higher, up in this range, and maybe some more time has gone by. So you're thinking that this red line is going to be sitting a little higher up into here. But instead you find out that volatility for some reason has gotten pumped up on this short strike, and now it's doing this. And so even though ultimately at expiration this blue line will also come up here and meet the black, it's not going to do it for a long time. So while you were thinking that you were getting closer and closer to this black line and getting into a more profitable position, you were actually sinking lower and lower. So what do? Do you sit longer on the position and maybe have the stock go against you? Or do you close it out for a loss, even though you were in what appeared to be the winning zone? See, this happens a lot with spreads. So another problem that traders run into is early assignment. And what happens is that traders panic and they say, oh, I got assigned early on my short position. Or let me close out my vertical spread because it looks like I might get assigned early and I don't want any problems. Well, if you understood your spreads, you would realize that early assignment is a gift, not a risk. So let's go back to saying that you're long the 100-105 vertical spread, but you get assigned on your short 105 prior to expiration. Okay, so that means you're now long the $100 call and you're short 100 shares at 105. Why? Because if you get assigned on the 105 call, you have sold shares at that strike at 105. Now, because you didn't have the shares, you still have to sell the shares. Remember, the exercise is always for the underlying. So the broker is going to leave you with a short 100 share position at 105. But think about what happened. Mathematically, in our example, you were long shares at 103, right? Because you have the right to buy shares at 100 and you paid $3 for this spread. So mathematically, you're long at 103, but you just got assigned with a short stock position at 105. So on a net basis, you've got a guaranteed $2. But you've also changed your risk graph. So for instance, your original risk graph looked like this. This is the long 100-105 vertical spread. When you got assigned, you were ending up being long the $100 call at 3, that's the blue line, and you're now short shares of stock on the red line. But these two graphs, the red and the blue combined, actually give you this. Notice that you've now got a position where you can't lose. And again, that's because you were long at 103 and short at 105. But notice that you now have a free put option, better than free. You've got a net credit of 2. You cannot lose, but you might make more. And in fact, this is the only time that you can make more than the difference in strikes for a vertical spread, is if you get assigned early. And of course, that's not your decision, but that's why it's a gift. But you need to know that, and you need to know what to do and how to potentially hedge, roll, or morph this as things change. So yes, just remember, it is true, spreads are powerful, but they are fairly complex. And the basic reason is that you have not one, but you've got two options, one long and one short. And you must understand how spreads become profitable, how volatility will change those values, and you must also understand early assignment. And those are just some of the basics. But if you're trading spreads just because you think they're easy because you can lose less, there's still a lot more you need to learn. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.